What is price to earnings ratio, also known as PE ratio? Price to earning ratio, or PE ratio, is a tool that investors use to help value a company. It's one of many tools. The process involves taking the annual income or profit of the company and dividing it against either the share price or the market capitalization of the company. And then this multiple is referred to as the price to earnings ratio. This tool can be used to estimate a notional payback period. As an example, if a company were to have a PE ratio of 5, one might think if I bought the company in its entirety, it would have a payback period or payback time of approximately 5 years, representing a PE ratio of 5. Not many investors actually go out and buy full companies in their entirety, but it's a nice tool to have to go through the notional exercise process of calculating what the payback period time would be. Let's take a look at a real life example of a company and do a quick calculation of PE ratio. Here's the stock price quotation for a company called Halak Bank of Kazakhstan. This company is based in the country of Kazakhstan. It is the leading bank of that country and a leader in the Central Asian region for banking services. The price of the stock is quoted at 344.79. It is quoted in a foreign currency, their currency called the tenge. And here is a chart, long-term chart for the stock. If we look at a recent annual report for Halak, we can see that on page 10 of the annual report, there is the income statement. For the year ended December 31, 2024, if we scroll down and look at the bottom of the statement, we see quoted earnings per share. This is the total net income for the year, divided out by the total number of shares. There is a note here in the note column, note number 32. This note at the end of the document will likely explain how many outstanding shares there are and how they arrive at that calculation of 84.50 in terms of net income on a per share basis. So what we would do is we would take that net earnings on a per share basis of 84.50. We would pair it with the share price. We would take the share price of 344.79 and we would divide it by 84.50. On my calculator, that's producing a number of 4.08. So that tells me that the PE ratio, or the price to earnings ratio, the share price divided by the earnings price on a per share basis, is 4.08. So the current price earnings ratio for this company is just over 4. To be precise, it's 4.08. So technically speaking, if I wanted to calculate what my payback period would be, assuming that every year going forward, the earnings would be the same or higher, I could do the reverse. I could take that figure of 84.50 divided by 344.79, and now my calculator is giving me a fraction of 0.245. That represents an earnings yield of 24.5%. So if I were to buy the company in its entirety, and if I was lucky enough to see that the company produced the same net income every year for the following 4 or 5 years, what I would experience would be a yield on my money, on my purchase price of 24.5%. That's why we call that an earnings yield. But I would also see a payback period of just slightly over 4 years. Meaning if I were to buy that bank in its entirety and you put in my pocket the net income at the end of the year for those just over 4 subsequent years, I would receive a full payback of my money. So this is one tool, the price to earnings ratio, also known as the PE ratio. It is one tool among many that investors use to help calculate payback period or to help them to determine whether or not a company is a good investment or not. Let's do one more quick example. Here I have the price quotation pulled up for a company called Amazon. The current share price is $214.80. I also have here a recent annual report showing the year ended December 31, 2024 earnings on a per share basis. Now this is the income statement section of the overall financial statements of the company. And on the right-hand column of the statement, I see the figure 5.66 printed. So that tells me that on a per share basis for this one specific year alone, not making any adjustments to the income statement, but for this 1 year alone, on a per share basis, the company earned $5.66. So what I could do is I could take back out my calculator and type in 214.80 divided by 5.66. My calculator tells me an answer of 37.95. So for the Amazon company, the price to earnings ratio for the year of 2024, that ratio is 37.95, meaning that it has a PE ratio of almost 38. So that's quite different from the PE ratio that we saw at Pollock Bank, which is about 4. Now, a very interesting question might come up, and that is, what if the prior year earnings were larger or lower in a dramatic way? Or what if the following year earnings are dramatically higher or lower? How can we have a reliable PE ratio? Well, in a spectacular book called Security Analysis, this is an absolute must read for people who enjoy stock analysis. The book talks about the concept of using earnings over a period of time. So as an example, what an investor could do is they could take the 3-year, 5-year, or 10-year or longer snapshots of the net income or net profit of the company for the year, average them into one specific number, and divide it against the current share price to get a more reliable number as measured over time, looking backward. Let's look at a quick example of that. Here's some historical information on this company called Pollock Bank. I've taken the share price right here, the market share price of $344.79, and I've arranged against their earnings on a per share basis going backward over time. If we take the earnings on a per share basis over the last 5 years and divide it into the current share price, we come to a PE ratio of about 6.38. If we go back further and look at the 10-year average, it's about 9.64. Going back further, the 15-year average is about 13.39. So by creating a PE ratio that goes backwards in time for longer than periods of just 1 year, we're able to see more things. We're able to see if the earnings have been explosive just in a very short period of time, and we want to know what's the reason for that. And there can be various reasons. There can be extraordinary earnings that started at the beginning of the period, but as the years went by, they may have just declined lower and lower and lower. We're showing a recent PE ratio being very high, but a historical one being very low. That will help us in our overall process of trying to learn about a company, learning about its history, and deciding whether or not it may be attractive or not. So the price to earnings ratio, or PE ratio, is a tool that investors use to help value a company. The process involves taking the annual income or profit of the company and dividing it against the share price or the market capitalization of the company to try to estimate what the payback period would be if the investor bought the entire company. The information used to calculate the PE ratio is found on the income statement, which is a very important component of the financial statement, which are typically reported by the company on a quarterly basis, nearly always found on the company's website, a regulatory filing website for the country in question, or for the stock exchange website, the filing section for that stock is listed.